Hello and welcome to today's Life Insurance and Taxation Modules Exam Prep Bootcamp. My name is Sam Albanese and I will be your instructor today. As always, I will try to answer all your questions as we go along, but remember that I can't obviously give you too much detail, but I will certainly do my best. But remember that after the session, you can always go back to your email address that's on your contact page of your website and email me, and I will be more than happy to respond within. Usually we will respond within 24 to 48 hours. We do get quite a few of them, so we certainly welcome them. So you're more than welcome to email me after the facts and everything else. But in the meantime, like I said, I will do the best I can to answer them as we go along. Like we've done in the past, obviously for any of you who attended these sessions before, we're obviously going to review the content, clarify probably any ideas that concepts you may have, and of course, as we go along, answer any questions and everything. So the first thing we're going to do, because we are talking about money, obviously, the very first thing we're going to do is we're going to talk about the whole concept of before and after tax dollars. Okay, this is of course something that most people seem to have a difficulty with. So to put it in sort of context, when you get your paycheck from your employer, let's say, and he shows the top line, whatever it is, $1,000, whatever, and then you actually see the actual amount on your check, and you notice that it's like, say, it's like $700. Well, that $700 is really your after-tax dollars, essentially. That's really what we're talking about. Okay? However, when we talk about investments, we do have to talk about before and after tax dollars. So in our example that's in front of you right now, let's assume that you wanted to invest $100. In other words, or you bought an insurance policy that with a $100 a month premium or something. So the obvious thing is, well, how much money do I have to earn on a gross level in order for me to actually have $100 in my pocket so that I can pay this premium? And let's again assume that your average, your tax bracket, let's say, is 30%, which is fairly consistent with the vast majority of the population of Canada. Is the vast majority are in the 30% tax bracket. That means that basically 30% of the money is gone before you even see it, and all you've got left to spend is really 70%. So the question obviously is, well, if I want to pay a $100 premium, how much money do I have to earn at a gross level in order to get $100? Well, it's really quite simple. Take the $100, divide it by 70%, because that's all you get to keep, basically. And you notice in our example that we have $142.85. In other words, in order for you to pay your $100 premium a month, let's say, you need to earn $142.85 to make that possible. That's essentially what we're saying, okay? The second kind of income, of course, is what we refer to as before tax dollars. And this usually happens before deductions. In other words, if you can't deduct the premium, if you can't deduct, later on we'll talk about, registered money, non-registered money, that kind of stuff there. So usually when we talk about deductions, basically that is a before tax dollar. So in other words, if you were in fact had a $100 premium, but you were able to deduct that $100 premium against income and everything else, then that basically means there's no tax that has to be paid. So $100 is in fact a real $100. So therefore, $100 before tax is $100 before tax, period, because you are deducting it. Whereas in the first example, the $100 is after tax. That means you have to earn $142 in order to make basically $100 in investment. So I hope that clarifies a little bit of that anyways. For the most part, in our when we talk about life insurance, we're usually talking about after-tax dollars. When we talk about investment dollars, for example, for RRSP purposes and everything else, we will be talking about before-tax dollars. But we will have sessions on that later. For now, let's just focus our attention on the after-tax dollars, okay? So again, staying with that sort of deductibility of the premium, the premium that you pay for your insurance policy is always after-tax dollars. In other words, you as an individual policyholder, or even if a company, let's say, owned a policy on your life, it would always be with after-tax dollars. And the reason for that is because we want the benefit that's paid out to you tax-free. So if, for example, you insured yourself for $500,000, and let's say it was before tax dollars, that means then that at the time of death, that $500,000 could be taxable. Well, the last thing your beneficiary wants is a big tax bill. That's why premiums are always after-tax dollars, whether it's policies owned by an individual, in other words, you, or your company owns a policy on you. It's always with after-tax dollars. That way, when the $500,000 gets paid out, it will be totally tax-free. The other area you have to look at is a group insurance. Some of you may be employed where there is a group insurance plan. And again, we'll talk about group insurance in a later session, but for our purposes today, basically the employer pays a premium on your behalf, and of course deducts it from their expenses and everything else. However, this is the tricky part. It will show that deduction as a taxable benefit to you as the employee. So once again, if we go back to that $100 that we were talking about, basically what we're saying, yes, they can deduct $100. That's not a problem. But that $100 will show up as a taxable benefit to you. In other words, when things show up on your T4 as a taxable benefit, the reality is it's not the employer that's actually paying for it. You're actually paying for it yourself. And the reason, again, why we do that is because, once again, when you die and the $100,000 benefit, let's say from your group insurance, death benefit payable to your beneficiary, you want that beneficiary to receive that money tax-free. If the employer did not show that $100 as a taxable benefit to you, that means that at the other end, when you passed away, obviously your beneficiary is going to get $100,000, but it will be taxable income. And again, that's the last thing that a person receiving a death benefit wants. They want it totally tax-free. So once again, when we are talking about life insurance, accident sickness insurance, anything along that line, we're always talking about after-tax dollars because we want the benefit to, in fact, be totally tax-free. Okay? So let's move on. Another very, very important notion is what we call a capital dividend account. Now, this account really only applies to Canadian-controlled private corporations. In other words, these are not accounts where the stock is actually traded on the TSX or the TMX or the New York Stock Exchange. That's not where it works, okay? This is really for private corporations. And as I said, it is Canadian-controlled, the private corporation, what they call a CCPC. And so basically, if it is a Canadian-controlled private corporation, then you have a capital dividend account. That account is referred to as a notional account. In other words, it's not a real account. In other words, you don't go to the TD Bank, let's say, or whatever. It's okay, I want to open up a CDA account. It doesn't really exist. It's a notional, a virtual account, which is only used when, in fact, there is a capital dividend that actually has to be paid. Now, there are a number of sources of capital dividends. So the two examples that I want to use this evening is the non-taxable portion of capital gains. So let me explain. Let's say that you bought stocks, let's say for $100,000 or a piece of property, whatever, and you sold it for $500,000. Okay, so you made a $400,000 capital gain. 50% of that will be tax-free, and that will go into the non-taxable portion of the capital gains. The other 50% you're going to have to pay tax on. So you see, the non-taxable portion of your capital gain, which is the 50%, automatically will go into the CDA account, from which that money then could be paid out to the owners, the shareholders, as dividends, tax-free. The other thing that's available, of course, is life insurance death benefits. So if your company owns an insurance policy on your life, so the example we've got here is XYZ Inc. owns and is the beneficiary of $1 million life insurance policy on your life. The adjusted cost base, and that, of course, is what was the premium that the company paid. Well, the premium in all these years, let's say, paid $300,000. So the cost of the insurance was $300,000 over so many years, whatever, in our example. And so, therefore, the ACB money is, of course, always tax-free because that's simply a return of your own money. So the only thing that goes in the CDA is the excess. So in our example, the excess is $700,000. So you've got $1 million policy. It costs us $300,000 in premiums. So therefore, $700,000 will flow to the CDA account, totally tax-free. And therefore, that $700,000 then can be paid out once again as dividend to the shareholders, totally tax-free as well. Now, like I said, there's all kinds of other. For that $700,000 then can be paid out once again as dividend to the shareholders, totally tax-free as well. Now, like I said, there's all kinds of other things that can go in the CDA account. But for our purposes and for exam purposes, all you need to really know is that there's a capital gain, the non-taxable portion of the capital gain, and the net value, basically, of the life insurance policy, the flow of the money. Let's say in this example, $1 million minus the ACB, that also flows into the CDA account. Okay, so when it comes to registering, non-registered money, basically in Canada, we have three types of income that you can receive. So if you've invested, let's say, $100,000, what kind of income could you get? Interest, of course, is the first one, which pretty well everybody's familiar with. The problem with interest, of course, is that it's 100% included. In other words, it is taxed at your marginal tax rate. There is no tax break whatsoever. So if you earn $100, you got to pay tax on $100. If you own $1, you ought to pay tax on $1, basically. So interest is taxed right from the first dollar. Dividends, on the other hand, get preferential tax treatment. Now, it's beyond the scope of this lesson to actually talk to you how dividends are actually taxed. But the important thing for you to know is that dividends do receive a preferential tax treatment because they have what's called a dividend tax credit. So therefore, not the entire dividend is taxed, unlike the interest, which is entirely taxed. The dividend, you'll see there's a portion of it which is not taxed, okay? But like I said, it's beyond the scope of this particular lesson. Just know that dividends have a preferential treatment under the Income Tax Act. And the last one, as we had talked about just moments ago, is, of course, the capital gain. The 50% inclusion rate, what we call, is, in fact, tax-free. So only 50% of the capital gain is taxed. That's called the taxable capital gain. That's the only part. So once again, I go back to my example of the $100,000 that you invested. You put in, and it grew to 500. You got a $400,000 capital gain. 200,000 will go into the CDA tax-free. The other 200,000 will be taxed at your marginal tax rate. So if you're in a 30% tax bracket, for example, 30% of $200,000, $60,000 will have to be sent to CRA. Okay, that's basically. So those are your three different kinds of income that you can earn from your investments: interest, dividends, and capital gains. And as I said, we're not really going to spend any time talking about dividends, but you must know about interest and you must know about capital gains. So I urge you to make sure, if you want further information on that, not only is it in Volume 1, the life insurance volume, but also remember that you also have a fifth module, which is the taxation module. You may want to review that module as well, because we won't have time to go through that in these sessions. Let's move forward. Now, as I said, we have non-registered money, which we just talked about, but there's also a second kind of money, which is what we call registered accounts. And these are, of course, monies that are to be used primarily for retirement purposes. Okay, so when you look at registered, think of retirement, basically. So the purpose, really, of registered accounts is to actually save money for your retirement. And because it's registered money, it will be pre-tax dollars, okay, rather than after-tax dollars. So registered money is always pre-tax dollars, and non-registered money is always after-tax dollars. So the type of tax benefit will basically the tax deferral on the principal and the income earned in the account. In other words, that interest, dividends, or capital gain that normally in a non-registered account you would have to pay tax on it right away, you can defer that tax all the way until you actually retire. At that point, then of course you have to start paying your tax at that point. So you're basically deferring your tax. You're not getting away from the tax, but you're deferring your tax. So examples of retirement accounts, which once again we will be talking about in later sessions. I think the third session or third week of November we'll be talking about these products specifically. But for our purposes right now, registered money basically is RRSPs, RRIFs, LIFs, LRIFs, RPPs. Those are all vehicles that once you invest money in there, you don't get T4s or T5s or T3s or anything along that line, okay? It's all tax-sheltered money. There's also tax deferral on income only. In other words, you can't deduct it, the premium, but you can certainly defer the growth. And that is RESP. Some of you may actually have RESPs for your children or something. And of course, RDSPs, Once again, we will be talking about these registered plans later. And the last one, which is a relatively new plan, it's since 2009, it is a TFSA. So these are all plans that technically are registered in a sense that when you invest money in there, the actual growth is not taxed immediately. It actually deferred until you actually take the money out at the other end and everything. Okay, so that's essentially enough about sort of taxation and everything. Let's move on now to a situation which is kind of unique in Canada, and that is what we call a capital loss. Nobody wants to lose money, obviously, but we do know that stocks go up, stocks go down, things of that nature there. So the government of Canada basically allows us some basically income tax break, you might say, if you in fact lose money. So capital gains gets a preferred tax treatment, as you know, which basically says that 50% of the gain is the only part that's income. The other 50% is tax free. So we know that. Okay, we just talked about it. However, as I said, you could have a capital loss. So therefore, capital losses are adjusted against capital gains in the same year. So for example, if you had Air Canada shares that went from $10 to $20, that means you had a capital gain of $10. But let's say that you had WestJet dollars, stocks, and it went from $10 down to zero. That means you lost $10. So basically, one offsets the other, and at the end, the result is you have no tax to pay whatsoever. So basically, capital losses are placed against the capital gains in the same year, or they could go back actually 3 years. So you can actually go back. So if you made money last year, for example, but you lost money this year, you could take that loss back to last year and get a substantial tax refund and everything else. So we can go back 3 years. You can also carry forward these losses indefinitely. So if, for example, you have no losses, you have no gains this year, so therefore, obviously, you can't put any losses, because unless you have a gain, you can't have a loss. So it doesn't work that, because you have to have a gain. But let's say next year you do, or the following year you do. That doesn't mean that just because you lost money this year that's it, it's over with. No, like I said, you can take it back 3 years or carry forward that loss indefinitely. And the day that you die, all your capital losses can be brought forward against all income, not just capital gains, but against all income. So it basically, it's really, really very good for your estate if they have these capital losses. You've never been able to use it while you were alive. At death, all these capital losses basically can all come together, and they'll go against all income, not just capital gain. So that's sort of one of the nicer things about the Income Tax Act, is that they understand that your stocks go up, stocks go down. In other words, you could lose money, and how do we make sure that you, as a client, as a consumer, are protected against those losses and everything? Okay, so the other area we have to look at is what we call a disposition. Okay, a disposition. And that is, a disposition basically means when you sell something, when you get rid of something, okay? Now, we all think in terms of the fact that an individual disposes of properties and everything that they may own. So in our example, which is a fairly common example, let's say you had a cottage. You bought a cottage, and the ACV on that cottage, in other words, the cost of you buying the cottage, was $100,000. When you sold that cottage, the fair market value was $400,000. Okay, so you had an accrued capital gain of $300,000. So the taxable capital gain, it will be $150,000. Okay, that's your taxable. Remember, $150,000 of that will be tax-free. The other $150,000, you're going to have to report that. And let's assume again that your marginal tax rate was 40%. So that means you have to pay tax of 40% on that $150,000. So when you're actually doing that, you'll see there that what ends up happening, of course, is that you're going to end up paying, let me just go back to my previous slide there. You're going to end up paying $60,000 in tax. In other words, 40% of $150,000 is $60,000. Okay. Now let's assume that it's you as a father. You got this property, and you would like to give this property to your son. So that's perfectly fine. There's nothing illegal about that. And still, even though you gave it to a family member and everything else, you still have to pay that tax. In other words, if you give it to your son, your daughter, or anybody else other than your spouse, which you'll see in a moment, you have in fact disposed of the property. Even if your son never paid $1 for it, in other words, it was strictly a gift, it doesn't really matter. As far as Ottawa is concerned, you have disposed of that property at the fair market value, and so therefore you as a father will be charged $60,000 in taxes on this particular transaction. Okay? Of course, your son now receives the property at $400,000, and that property now has an adjusted cost base for your son. In this case here, of $400,000. But stay with me on this because it gets a little more complicated. So let's go on to the next slide. So once again, we go back to the same thing that we have a cottage, $100,000. It's going to $400,000. Accrued gain of $300,000. Capital gain $150,000. But this time, what you decided to do was not to give it to your son. What you decided to do was to transfer ownership of the property to your spouse. Now, this is where it becomes interesting, okay? In that, with your spouse, in actual fact, what happens is there will be no taxation. In other words, in a spousal rollover situation, you can give your property over to your spouse, and there will be no tax implications whatsoever. So there is a spousal rollover, but there are no children rollovers. So if you give it to your son or your daughter, it is just the same as if you gave it to a third party. You're going to end up having to pay the tax on that. Whereas if you rolled it over to your spouse, either while you were alive or upon death or whatever, there is a provision under the Income Tax Act, which they call a spousal rollover. And so therefore, the tax will be deferred until the day that your spouse also passes away. And so therefore, the adjusted cost base, as you see there, in actual fact, your spouse will receive the property at the same ACB that you actually purchased it at, the $100,000. So the beautiful thing in terms of being married is this whole question of spousal rollover, in that there are ways and means of deferring taxes until your spouse actually passes away. In other words, until the second person dies. And this is where we get into joint last to die policies, for example, so that when the last spouse dies, there's enough money there to pay the taxes, so the children will receive the cottage on a tax-free basis. But again, we're getting a bit ahead of ourselves. But you can see that a spouse obviously has preferential treatment under the Income Tax Act, whereas your children, your siblings, and all that, third parties, they do not have preferential treatment. Only your spouse has preferential treatment. So, what happens when you die? Okay, so we talked about a living situation, but what about when you die? So, when you have a situation where in actual fact you're dead, okay, you are deemed to have disposed of all your worldly property at the fair market value upon your death. So there is what they call a deemed disposition. In other words, death triggers a deemed disposition. So even though you actually never sold it, the reality is that that's the time when the taxes have to be caught up. In other words, upon your death, Ottawa basically does a complete accounting and say, okay, we've allowed you to defer taxes all these years. Now you're dead. It's time to pay up, basically. So in the example here, same thing is a $100,000 ACB, fair market value of $400,000 at the date of death. You have a $300,000 accrued capital gain. $150,000 is tax-free. The other $150,000 is taxable. You're in a 50% tax bracket, let's say, so $75,000. So your estate will have to pay $75,000 to CRA in order to make sure that property stays in the family. Otherwise, the property is going to have to be sold or whatever, and of course that leaves the family. In other words, the capital gain upon death is the fair market value at the date of death minus the ACB. Fair market value, of course, in this example is $400,000, and the ACB was $100,000. Okay. Now, I draw again to your attention to that if this was a spousal situation, once again, the spouse will receive this on a tax deferred basis, and it will be when the spouse actually passes away. In other words, when the second person passes away, that the tax will have to be paid. But before that, there'll be no tax. Okay, so all we're saying is that sooner or later, you do have to pay your taxes, and that's all this to it. So once again, death triggers that deemed disposition. So the exemptions in Canada for the capital gain, there are a few areas where you do not have to worry about capital gains. Okay. The first one, of course, is your principal residence. Now, remember, in Canada, you're only allowed to have one principal resident per couple. So if you own a house and a cottage, you need to decide which one of these properties will be your principal residence, because the other one will be considered an investment. And then, of course, that will be subject to capital gain. So you have to decide basically which one of your principal residence. Okay. If you own a Canadian-controlled private corporation, you are allowed to take $800,000 lifetime capital gain exemption on that capital gain for a small business, like I said, a Canadian-controlled private corporation, or farm or fishing property. Now, that $800,000, by the way, is indexed. So this year's, I believe, is about $833,000 or something. So it is indexed to inflation. So it changes every year. But the point is that up to that amount at the date of death, okay, or the date that you actually sell your business, for example, you are allowed to take $800,000 plus out of the business without having to worry about any kind of taxation whatsoever. The rest of it, of course, you will have to pay tax on that. Life insurance death benefit, of course, is always tax-free. We always know that because we pay our premiums after tax dollars, then the benefit, of course, is tax-free. TFSA is also tax-free. You can't deduct the premium that you're depositing. The money that grows tax-free, and when you take out the money is also tax-free. And of course, lottery winnings, any windfalls, inheritances, things of that nature there. Okay, casino winnings and everything. All of that, of course, will be in tax-free. So any of you who won the lottery last week, got $40 million. You don't have to worry about reporting that because it is entirely tax-free. Okay, so when a person dies, of course, they have what's called an estate. Every one of us has an estate. And basically, I get this question all the time. So, well, what is the definition of an estate? Basically, in a nutshell, the estate is anything that has your name on it. So if all you've got is your car, that's part of your estate. It's as simple as that. Anything that you own, it forms part of your estate. It's really as simple as that. So what makes up the person's estate is property and property rights of the deceased. In other words, it's got your name on it, you own it, so therefore it's part of your estate. And as I said before, at death, you are deemed to have disposed of all your property at fair market value, whatever that means that fair market value happens to be. Okay. Now, the estates can be subject to probate. In other words, there's some properties where the will, for example, has to be probated in order to prove that it is your last will and all this sort of stuff there. And, of course, you have to pay tax. So for those of you who are in Ontario, it is 1.5% of your estate value. So if you have $1 million estate, it's $15,000 probate is your fee, basically. Okay? You also, of course, have to pay your capital gain taxes. Remember, all that deferral that we've been talking about eventually is going to catch up with you anyway. So the estate will have to pay any kind of capital gain taxes. Okay, and of course, you have to pay your creditors. Okay, of course, secure creditors such as the bank, your credit cards, all that sort of, they're what we refer to as secure creditors, and then of course unsecured creditors, and then the remainder being your beneficiaries and everything else. All of those people will be coming up to the estate, essentially saying, put their hand out, I want, basically. Okay. So after tax and creditors' estate is distributed. Okay, basically. What we're saying is that when a person dies, they die two ways, you might say. They die what's called a testate, which means they die with a will. Okay, so in other words, if you in fact have made a will, you have decided how you want your estate basically divided up upon your death. Okay, so therefore, the province of Ontario, let's say, or British Columbia, or wherever you may be, okay, has no say in all of this. In other words, you have decided upon my death, this is what I want to happen. So therefore, if you die with a will, you're dying with what they call testate. If you die without a will, which we do not recommend, of course, is you die intestate. In other words, everybody has a will. It's either the one you made yourself or the one the province makes for you. And the one the province makes for you may not be the one that you prefer, because obviously it may not necessarily fit your particular situation in terms of how you would have distributed the estate. Okay, but because you never told us, you died interstate, so therefore the province basically steps in and says, okay, here's how we are going to divide up the estate. Okay. Now, there are certain things, obviously, that may be subject to taxation, may not be subject to taxation. Okay, so proceeds of life insurance, RSPs, RIFs, RPPs, TFSAs are subject to taxation and creditors if you leave the estate as a beneficiary, and that's important. If you leave the estate as a beneficiary, so if you leave the estate as life insurance policy to your estate, your RSPs, your RIFs, your RPPs, TFSAs, and you name the beneficiary as your estate, then all of that will be taxed, okay, accordingly at the estate level. That's why we always recommend, and certainly in the life insurance industry, we have the wonderful privilege of being able to actually name beneficiaries, preferred beneficiaries, basically, that bypass the estate. So a nice way to bypass the estate is to actually have a named beneficiary, such as your spouse or your children, your grandchildren, your mother, your father, that kind of stuff there. Okay, if you name them as beneficiaries, then it does not go to the estate, so therefore the creditors cannot chase after that money. But if you name the estate as the beneficiary, then unfortunately creditors can chase that, because the estate is subject to creditor tax, is subject to taxation. So a cautionary note, make sure that your client are aware of the danger of naming the estate as beneficiary on any of these investments. You should always have a named beneficiary. So things that bypass the estates, which is what we just finished talking about, basically, is a property, for example, that has joint tenancy with the right of survivorship. So, for example, if I and my wife own this house and we own it on a joint basis, that basically means that if I pass away, my wife automatically steps into my shoes and she now has the house. Okay, so whenever you have a bank account or any kind of account or house or cottage or whatever, what that is actually registered on a joint tenancy with right of survivorship, when one person dies, the other one automatically steps into shoes. So there's what they call that spousal rollover, basically. There's that rollover provision, which means you can defer the taxes further until the second person actually passes away. Okay, so the spousal rollover is a key element of basically income tax planning and everything else. Okay. And as I said before, if you name a beneficiary, in other words, not the estate, all of the following products will bypass the estate, will bypass creditors and everything. Okay, so life insurance, RSPs, RIFs, RPPs, TFSAs, okay. As long as that money goes directly to the beneficiary because they're named as beneficiaries, then we're good. If you name as the estate, then obviously we've got a problem. Okay, so again, I urge you to check that out with your clients on any existing insurance policy that they may have. They may not be aware of the danger of naming the estate as the beneficiaries. Okay. The other thing you should know about the insurance industry, in terms of monthly payments, most people would like paying their premiums on a monthly basis. It's monthly pre-authorized. It's very simple. It's painless, that kind of thing there. However, we have to understand that because it is monthly, then obviously we have to have what's called a modal premium. And so basically the formula is the monthly premium is the annual premium times the modal factor. For most insurance companies, the modal factor for monthly premium is 0.09, as you can see there on your screen. Okay, so let's say that your annual premium is $2,000. Okay, but the guy said, "No, I can't afford $2,000. Can I do it monthly?" The answer is yes, but it's going to be 2,000 times 0.09, and that is $180 is going to be per month. Is going to be the premium. So now, when you do the math on that and you multiply the 180 times 12, you discover that the annualized premium is $2,160. In other words, there is a premium, there is a surcharge that you must charge your client if they decide to pay for their term insurance or their whole life policy or the disability policy or whatever it is on a monthly basis. They should be aware that they will be paying a little bit more, basically, because the insurance company is essentially financing, you might say, that $2,000 premium. And so therefore, they have to get paid. They have to get that opportunity cost, you might say, reconciled. And they reconcile it by charging basically 0.09 times the annual premium. So the annualized premium in this case is 2160, whereas the annual premium is in fact 2000. An interesting twist, however, is that universal life, as you'll see later, universal life, you simply divide by 12. It is the only product that the insurance companies sell, the only life insurance product that the insurance companies sell that does not have a modal premium. And as you'll see later, the reason for that is because universal life is predominantly an investment product that happens to have a term insurance rider attached to it, you might say, whereas all the other products are in fact true insurance products, so therefore it's a modal premium. But because universal life is really an investment product that happens to also have a rider, which is an insurance component to it, you simply divide it by 12, and that's it. So universal life, no modal premium. All other insurance products sold out there, there is a modal premium. Okay, so let's move forward. So let's take a look at term insurance first. This is, of course, a product that, for younger people in particular, the vast majority of people will buy term insurance. That's really what they will do. Okay. Term insurance, the beautiful thing about term insurance is that it's relatively inexpensive. Okay, so if you're dealing in a younger market, millennials, things of that nature, the expenses that they may have are very high. In other words, if you're living in areas like Toronto, Vancouver, Calgary, things like that, you all know what the mortgages are like. You all know what the price of house are. And so therefore, they may be looking for a great deal of coverage, but don't have very, very much money. So term insurance is a great way of doing it. So basically, when we look at term insurance, there is obviously operating margins that have to be covered, and those are what we call policy fees. And so we have to cover the administration costs, commissions for you as a salesperson. We have obviously underwriting, and of course, the insurance company have to make money as well, so profits, right? So essentially what happens is that the insurance company will look at the cost of the insurance, in other words, the monthly cost, basically, times essentially the policy fee, and that will be the actual premium that the client will actually pay for. So in the example we have here, let's say that the annual premium was $194 for, I believe it's $100,000 of coverage, but that's neither here nor there. So that's not important. So the annual premium is $194, and the modal premium will be 0.09. So the consumer, your client, will pay $17.46. Okay. One of the nice things about term insurance, of course, like I said, it's relatively inexpensive. The problem, of course, with term insurance is that it has an expiry date. In other words, it will be termed to whatever, termed to 65 or termed to 75, or 20-year term and all that. So therefore, unlike permanent insurance, which covers the client for the rest of their lives, term insurance is in fact temporary insurance. So you have to be aware of that, that there is a time limit. So if the client dies within that time frame, then of course the policy will be paid out. At the end of that time frame, then it is, the policy will have expired. So if the client dies after the term expires, there is no coverage whatsoever. Okay. Essentially, there are two types of term policies. There's what's called level premium. In other words, the premium remains the same all along and everything else, okay, forever and a day. So you're paying a little bit more up front, as the chart is saying there. Basically, what that chart is saying here is that to levelize that premium, basically, here's your cost right here at the bottom, but you can see you're actually paying a little bit more. But eventually, that a little bit more that you're paying now pays for the premium in the future, when in actual fact you're actually older, and therefore the cost of the insurance will be that much higher. Okay? So it avoids the shock, you might say, of a much more bigger premium later on in life. And of course, the other one is YRT. Which means that it goes up every single year. Yearly renewable term insurance, it goes up every single year. Sometimes it's 5-year renewable, sometimes 10-year renewable, whatever. So the point is, let's say it's 10-year renewable, which is the most common one. That means that every 10 years the premium goes up. Okay, essentially, every 10 years it just simply goes up. But again, later on, it can be prohibitively expensive as well. So it's something you need to make sure your client is aware of. that's the kind of thing that can happen. Okay, so a lot of people like the idea of having a consistent premium. In other words, I want to know exactly what it's going to cost me forever and a day. I don't want any surprises, that kind of stuff there. So the level cost of insurance concept is very, very important, okay? So term to 100, for example, which is permanent insurance, as you can see by the chart that we're looking at here, you can see that level premium. So let's say that premium was $1,000 a year. It will always be $1,000 all the way through. However, if you look at the light green part versus the sort of bluish part at the bottom, you'll notice that in the first year, you're really paying a much, much higher premium than you really should be paying. In the second year, you're paying a little bit less, and so on and so on and so forth. So what you're really doing with that green part here is you're actually sending money ahead of yourself so that at the later dates, so over here, let's say when you're in your 50s and your 60s, where the premium really could be quite substantially higher, the insurance company has a reserve of money because you've sent money ahead of yourself. They've invested that money. And so therefore the end result is that that premium will continue to be $1,000. It will not go up at all. So that's why this increase here, you don't have to worry about that increase. So the cost of the insurance continues on going up. But because you paid, you might say, in advance, you don't have to worry about those costs at all. So the level concept is a very interesting idea for the life insurance industry because, like I say, most people do like the idea of knowing so they can budget properly and so on what their future premiums will be like. So essentially, you pay a little bit more up front, but you really save a lot more later on. So it's the same old story: pay me now, pay me later. Obviously, if you pay later, it's going to cost you more. It's really as simple as that. Okay. So with whole life insurance, basically what we're saying here with whole life, which is a very common type of product. What you've got, essentially, is a permanent insurance, like the term to 100, okay, basically. And the name whole life is really important because it means that you're paying a premium for the whole of your life. And you're also covered for the whole of your life. Now, most companies, what they'll do is they'll stop premiums at age 100. However, some companies will pay out the amount of money at age 100, or in some companies will say, no, until you die, when you die, we'll pay it out. In other words, we die 110 or something, we'll pay it out. But we will not take out any money from age 100 onwards, okay? In other words, you're fully paid for and everything else. So once again, we look at the level concept here. And let's assume that this was 500,000. I believe it is 500,000 of coverage. So you can see the insurance being the green part and sort of the, reddish, whatever, mauve color, whatever, there, that is the reserve. Okay, so as the years go on, as you're paying your premium, you're building up a substantial reserve so that at age 100, the amount of money or the amount of reserve that you got is equal to the face amount. So if you look at the chart on the right side here, you'll see that 10 years from now, in other words, this started at age 30, at age 40, you got $30,000 worth of reserve, $5,000 at age 50, $100,000, so on and so forth. And then at age 100, you've got $500,000 in reserve. Okay, so that money then will be paid out to you. In some cases, companies will pay that out while you're alive. In some cases, they'll say no, we're going to wait until the actual person dies. So you sort of have to look at the contract to see what the insurance company's policy is on these issues. But the good thing about all of this is that everything that you see on that screen is guaranteed. Okay. In other words, if the client said to you, okay, well, at age 70, how much money do I have? And the illustration that you gave the client shows $270,000. You can say to the client, Mr. Jones, at age 70, you will have $270,000. So if you cash out, forgetting about taxation for a moment, okay, but if you cash out, you're going to have $270,000. In other words, this is a fully guaranteed product. And as Canadians, we tend to like that kind of stuff. We like guarantees. We like to know where we stand. We like to know what our premium is. You know, we're very conservative in that area. So whole life insurance is an excellent product for that kind of consumer that really would like to know where they stand all the way through. Okay. Where am I here? Here we go. So when we look at universal life, it's a slightly different type of situation, okay? Universal life, it really consists of two plans, basically. It consists of an investment component and life insurance, okay? And you'll see that in a moment. So when we talk about universal life, the first thing we look at is the fact that the client, of course, deposits money into an account. So think of this, for example, as a bank account. Okay, all of you have a bank account. When you get paid, the money goes into your bank account. Okay, and that bank account here is called the account value. Okay, so the account value is deposit of your money plus any earnings and all that is your account. From there, the insurance company automatically deducts premium tax. Now, depending on the province, that premium tax could be anywhere between 2 to 4%. Again, the consumer never sees all of this. They gave you their $1,000, they deposit into the account, basically, and the insurance company automatically takes out anywhere between 2 to 4% from that. Then they will deduct the YRT or level cost of insurance. And again, we'll look at that in a moment. You'll see what that's all about in a moment. We will deduct the policy fee. We'll deduct any riders that they have. So think of this again, is you deposit your $1,000 in your bank account and you wrote some checks. Okay, you wrote a check for $100 for your Visa card. You wrote $200 for your car insurance, whatever it was. The same idea, except that in this case here, the insurance company actually does it for you. So from the consumer's perspective, they just simply deposit $1,000. All of this is done internally. So there's an actual deduction for the amount of the cost of the insurance, whether it be yearly renewable term or level cost of insurance, the policy fee, of course, any riders, and then whatever is left from that $1,000. So let's say you got $300 left. The balance is deposited into two different kinds of accounts, depending again on the consumer's choice. The consumer is very conservative. He may want to put his money into GICs, daily interest accounts, or bonds. Or the consumer may say, no, I don't mind taking some risk. I'm young enough, I can take a loss and all that sort of stuff. They can put money into mutual funds or segregated funds. Okay, so with universal life, like I said, what you really have is an investment account, which can either consist of GICs, daily interest or bonds, or higher risk, which are mutual funds or segregated funds, okay, and an insurance policy. So if the person prematurely passes away, the insurance policy pays out. If the individual lives and he's in the 60s, 70s, 80s, whatever it is, and then decides that he wants to now start taking money out from his policy, then of course he's got that investment account attached to it as well. So when you look at universal life, think of it as two products. Okay, in terms of the death benefit, okay, in other words, the net amount at risk, the NAAR, net amount at risk, is equal to the death benefit minus the investment account value. In other words, if the death benefit was $500,000, but you have in your deposit account, your investment account, $100,000, then the insurance company, should that client die, is only on the hook really for $400,000. Because the other 100 is already in the pot, basically. Okay, there's already investment money sitting in there. So the NAR basically is the amount of coverage minus the investment account. So in the example I just gave you, if you have $500,000 and you've got $100,000 in your investment account, then really the insurance company's liability only rests at $400,000, and that's it. So you can see as the years go on, as the investments continue to grow, the net amount of risk for the insurance company gets less and less and less, and because ultimately at age 100, the net amount of risk is actually zero, because the amount of cash that's sitting in there is equal to the face amount. Okay, let's go on. So let's talk now about universal life. This is, of course, a major product, and I stress to you, please make sure you read the section in the book on this, because there usually is a number of questions on universal life. So when we talk about universal life, as I said before, it's a combination of two products, insurance and investments. So policies that last acquired, these are very important dates, so please mark this down. Policies last acquired prior to December 2nd, 1982 are automatically exempt policies. In other words, you don't have to worry about taxation. You don't have to worry about testing these things for taxation or anything. So policies that were acquired prior to 1982 are grandfathered, you might say. Policies that are last acquired from December 1st, 1982 onwards can be exempt or can be non-exempt. And we need to look at both of those right now. So let's take a look, first of all, at how does a product that is issued, acquired after December 1st, 1982 maintain its exemption status. And remember that when we're talking about exempts, what we're talking about is a tax sheltered. In other words, there is no there's no T3s, no T5s. So you put money into your investment account. It is it's exempt, which you'll see in a moment how we do that. So therefore, even if you make money on that investment account, you're not going to get a T3 or a T5. So when we talk about an exempt product, it basically means a tax deferred product. When we talk about a non-exempt product, we're talking about a product that you have to pay tax on it every single year. Okay, that's basically what we're talking about. So let's take a look at a product that is exempt. And let's assume for a moment that you're 30 years old. And once again, you've got $500,000 of the coverage and so on and so forth. So you'll see there that in this graph, basically, you'll see there this line, which is a very important line, and this is what they call an MTAR line, or maximum taxable actuarial reserve, the MTAR line. So basically what we're saying is that as long as the amount of money that's in the investment account is equal to or less than, in other words, it's below that line, so this part here, okay, then the product is exempt. And so therefore, whatever earnings are in there will stay exempt. So no T3s, no T5s, nothing like that at all. As long as the money is sitting in that policy, and it is below that particular line, therefore, the client will never receive a T3 or T5. So therefore, the growth on that will be tax deferred. That's the beautiful thing about this. So how a product maintains its exempt status is that it must be last acquired after December 1st, 1982. And the investment amount in the account value, in other words, cannot be greater than the MTAR line. Okay, it's got to be equal to or less than the MTAR. Then the policy is exempt. Okay, and if by chance that investment account goes above the MTAR line, so therefore it's up here somewhere, so you had a really good year, then it will be considered non-exempt. In other words, you're above that line, so therefore it is an investment product. And as far as auto was concerned, if it's an investment product, then you must pay your tax on it on an accrued basis. And so therefore, how a policy loses its exempt status is once again last acquired from after December 1st, 1982, okay, and the amount of money in the investment account is above the MTAR line. So if it's below the MTAR line, it's exempt. If it's above the MTAR line, it's non-exempt. It's really as simple as that. So what is the remedy just in case a product does go non-exempt? In other words, you have been putting in a lot of money. The investments have done very, very well. So now is a possibility that may actually go above the MTAR line. Is there some remedy that could be used before Ottawa comes back and says, okay, it's investment time to pay your taxes? Yes, there is some remedy, and that's what they're saying at the bottom of that, which is the non-exempt remedies. You can increase the face amount. Insurance companies will be able to increase the face amount by 8% a year without medical evidence. Okay, so automatically the insurance company will simply increase the coverage by 8% a year to make sure it stays within that. So that basically by increasing the coverage, so your 500,000, for example, will be 520,000 or something, whatever. Then that means that MTAR line will be increasing, so it'll be up here somewhere. So that gives the client a bit of investment room, you might say. The other thing, of course, you can withdraw money. In other words, take the money out. So you're going to get a letter from the insurance company saying, you've got $60,000 that's over the line. What do you want to do with it, basically, and you can simply take that money, pay your tax on it, essentially, and that way the rest of the money that's sitting in your account will be tax exempt. If you don't do that, then the whole thing becomes taxable. So you got to be careful of that. And I should tell you that you need to make that decision within 60 days of the anniversary of your policy. In other words, you've got a 60-day to make this thing happen. If you don't do it, if you don't tell us to make a decision within 60 days, then it's quite possible that it will stay non-exempt, and therefore Ottawa will come back and tax you accordingly. Okay. The other thing you could do, which is the fail-safe method, of course, is transfer the taxable side to the side account. All universal life policies have a side account. And so there it's automatic. It's already built into the product. So you don't have to order or anything. You simply have to say it's there. So if you do not respond to the 60-day notice or whatever, in other words, you haven't made up your mind what you're going to do, the insurance company automatically will transfer that excess money to that side account. That side account, of course, will be taxable and everything else. But the idea here, you see, of having these three options is to make sure that the plan stays exempt. Because once you lose the exemption status, you lose it forever. You never get it back. So if you lose it this year, for example, and you bought the policy 20 years ago, it'll go right back to 20 years ago, and it'll be taxed every single year. So it can be quite a substantial amount of tax that needs to be paid. And you can't say, okay, well, I paid my taxes, or now from now on I'm going to be a little more careful. No, you've lost the exemption status, period. So it is crucially important. And so the insurance companies recognize that, and that's why they have these sort of fail-safe mechanism, you might say, to make sure that the policy always remains tax exempt. So as I said, the investment account is really the driver of the policy, basically, because the client basically puts the money into the investment account, and from there, of course, all the deductions are made. What did it cost to insure you? Policy fees, riders, all that kind of stuff there. Then the client decides whether they want money into guaranteed investment accounts, daily interest accounts, mutual funds, stock indexes, NASDAQ, Nikkei. In other words, lots and lots and lots of places. But as long as that investment account, so the account value here says $60,000, and the face amount is $300,000. So as long as the amount of money is equal to or less than the MTAR line, then it will be tax exempt. The money that moves outside of that account, it goes into the side fund, that is, of course, non-exempt. Okay, non-exempt. You will have to pay tax on any growth on that. So the whole idea here is to keep the money that's sitting in the investment account exempt, because upon death, that money will be tax-free. So you don't want to get stuck with a big tax bill when a person passes away. That's the last thing a beneficiary needs is a big tax bill when a loved one has passed away and everything. Okay, so that's the idea of making sure that investment account always stays exempt, and that's why we have that side account, so money can basically be moved over. Okay. Now, Universal Life is very unique in that it also has 4 different death benefit options. Okay, 4 different death benefit, and you will definitely get exam questions on these 4. Okay, I'll tell you the one that they usually hit you with in a moment. Okay, the first one is level death benefit. So in our example, we've got $300,000, and let's say that you died. Okay, then you get $300,000. In other words, level death benefit, the death benefit is simply $300,000, and that's it. You pass away, $300,000 gets paid. But if you chose level death benefit plus the account value, in other words, plus whatever's inside, plus that $60,000 account value here, then the death benefit is $300,000 plus the $60,000. Okay, and so therefore $360,000 gets paid to the beneficiary. Once again, tax-free. Remember that $60,000 was in the exempt account, and so therefore upon death, that money will be tax-free. So number 2 is the one that most times you're going to get on the exam, is the most popular option. You must choose these options, by the way, at the time of underwriting. In other words, at the beginning of the case itself, not after the fact. It has to be done at the time of underwriting. So level death benefit plus account value basically says we'll give you the level, which is $300,000 in our example, plus $6,000 worth of cash, totally tax-free. The third one is level death benefit plus accumulated gross premiums, in other words, ROP. This is predominantly used by employers who buy insurance policy on their key person, for example. And so let's say that you were working for me and I'm paying $1,000 a year in premiums for your $300,000. The $300,000, your wife or your spouse, whatever, is your beneficiary. In other words, I'm not the beneficiary. Your spouse is the beneficiary. So if you passed away, how do I recover my $1,000? So let's say that you passed away 20 years from now. So I paid in $1,000 a year for 20 years. I paid in $20,000. What will happen is the insurance company will take the $300,000, pay that to the beneficiary, let's say your spouse, and the $20,000 will be paid to me, the payor, basically. Okay, so it is, like I said, predominantly used. So option 2 is predominantly used by individuals. Option 3 is usually used by corporations that will insure their partners or key people or whatever the case may be. Option 4, level death benefit plus indexing, not very popular, but you need to be aware of it. This is where the client is saying, well, $300,000 sounds like a lot of money and all that right now, but 10 years from now, it only buys $250,000 worth of goods because of inflation and everything else. How can I protect myself against the erosion of the death benefit and the purchasing power? Well, you can buy an index. In other words, you can have your $300,000 indexed, and that could be indexed according to consumer price index. It could be an actual number, 2%, 3%, 4%. It's up to you, basically. It's not very popular because it is the most expensive of all the options, basically, is that when you're looking at indexing, your premiums will go up every year as well because the cost of insurance, of course, is going up as well. So anyway, in any case, these are the 4 options, death benefit options that you must be aware of, and you will definitely get questions on probably at least 3 of them, but the most popular one that they usually will ask you is the level death benefit plus account value, so option 2, basically. Okay, so let's move on. Now, as I said, Universal Life is a combination of investment product plus the insurance element. And so because it's an investment product, Ottawa recognized the fact that the consumer could abuse their privileges in terms of tax sheltering, tax abuse and everything else. So, obviously CRA wants you to pay your taxes. So it has what's called the anti-dumping rule. And again, you must know this. This is very important for exam purposes. This begins at the 10th anniversary. Okay, so on the 10th, so before that, this rule does not apply. Okay, but on the 10th anniversary, the insurance company automatically uses this rule. And what it does is it goes back through year 7. In other words, 3 years backwards. And it will multiply whatever the account value was at year 7 by 250%. And that will be the maximum amount of money that the client can put in the 10th anniversary. So if, for example, in the 7th year, you only had $10,000, then you can put in 250% of $10,000, basically, is all you can put in year 10. So if you wanted to put in twice that much, you couldn't do it. It's as simple as that. So basically, the anti-dump rule, what they do is from the 10th year onwards, they go back 3 years. So as it says there, this test is done every year from then on. So in the 11th year, they'll look at the 8th year. On the 12th year, they'll look at the 9th year, and so on and so on and so forth. So again, this is a very important concept that you must be aware of for exam purposes. Okay. So the example that we give here, let's say that you have $50,000 in the 7th anniversary. And so 250% of $50,000 is $125,000. So therefore, the maximum that you can deposit in the 10th year is $125,000 to stay exempt. Okay. I mean, you can put in more if you want, but like I said, to stay exempt, it cannot be above $125,000. So what the company will do if you, let's say, put in $150,000, is they'll take the $125,000 and they'll put that in the exempt portion, and the other $25,000 will go into the side account, because the insurance company wants to make sure that always the plan is always exempt. So sort of guarantee that for you. So that's a very important concept to remember, is what they call the anti-dumping rules for Universal Life. It really only applies to Universal Life because Universal Life is the only plan where you can actually make additional deposits, whereas whole life, par, or non-par doesn't quite work with that. And certainly term insurance is automatically exempt because it doesn't have any account value anyways. Okay. So let's look at the needs that we cover through life insurance. Okay, most people will agree that you have both. So you have temporary needs and you have permanent needs. Let's look at the temporary needs first. Temporary needs usually are covered by term insurance, whether that's a level term, 10-year term, 10-year renewable, or term to 65 or term to 75, whatever. It doesn't matter. It is term insurance. And it's temporary needs because it is designed really to be for a very small premium, lots and lots of coverage, because you have children that you have to raise, for example, during the dependency period. Any of you have children will know quite quickly how expensive raising children are. You have children's education you have to pay for. You've got mortgages that you have to pay. Loans that you have, car loan, credit card loans, all this stuff there. In other words, the years in the, millennials and people in their younger ages, they have a very relatively small amount of money in relationship to the actual debt that they carry. And so therefore, in the unfortunate event that the spouse may die prematurely, the family could be devastated. But because they don't have a lot of money, they could buy, let's say, a term insurance product for a small amount of premium, very, very large amount of coverage. So in the event of untimely death, at least the death benefit is there. So you'll find that term insurance is very, very, very popular with the younger crowds. As you get older, your income starts to increase and you may be able to afford a bit more. Your temporary needs now may become permanent needs. In other words, permanent needs are basically needs that really never expire. They will actually expire really when you die, and that's it. In other words, they're going to be there forever and a day. So obviously funeral costs are permanent needs because none of us know when we're going to die. Estate taxes. Remember I said to you before, we all have an estate, and therefore they could be subject to creditors and taxation and all that stuff there. Okay, you may also want estate creation. In other words, you want to leave money to a charity. Many charities today depend on life insurance policies. So when the donor passes away, the life insurance policy kicks in basically in a big lump sum. So I ought to leave a nice legacy to your favorite charity. It's what we call estate creation. And of course, leave money to your loved ones. You leave it to your spouse, leave it to your children, your parents, whatever the case may be. Those are all what we refer to as estate creation. But those are all permanent needs because none of us know when we're going to pass away. Okay, and of course the other one is estate equalization. So let me explain that very quickly. Let's say that you had a cottage. The cottage was worth $500,000. You got 4 kids. And one of the children really would like to have that cottage. The other 3 aren't really all that interested, but obviously they want to have the equivalent value, let's say, of the cottage. Okay. Well, how you can do that? Because obviously you can't split up the cottage; it's only one property. So you give that cottage to let's say your oldest son or daughter, and the other 4 children. You could actually insure yourself for $500,000 and leave that money to the other children, and that will create what we call an estate equalization, okay? Because sometimes dividing up a property, one person may want that property, the other child may say, no, I'm not really interested in all, I'd rather just have the cash. Well, that means you have to sell the cottage in order to get the cash, and that sort of defeats the whole purpose. So one way of doing all of this is, okay, here's the cottage for child number 1, and then I'll insure myself so that child number 2 and 3 and 4, whatever, will have the death benefit. So they still get the value of the cottage, but it will be in a cash format versus the cottage itself. So once again, for all of these purposes, the best products to use is not term insurance because, like I said, term insurance has an expiry date. Most term insurance plans will expire at age 75. Okay. Today, of course, we're living longer than ever, so most of us will live well beyond age 75. So term insurance doesn't do the job for that particular issue. Okay. So the 3 different products that are available for permanent insurance: Term to 100, whole life insurance, participating or non-participating, of course, and universal life. Okay, those are your 3 main permanent insurance products that expire basically the day you expire, but they will never expire prior to that. Okay, so the next thing we have to take a very deep look at is say, okay, well, how much insurance do I actually need? I mean, your client is going to say, well, what do I need? How much money do I need to insure myself for? And it's a very legitimate question. And today, you're very fortunate because you have a lot of software and everything else that you can plug in, all sorts of wonderful numbers and everything else, and the calculations are essentially done for you, so you can figure out how much insurance. But if you didn't have that that sort of software and everything else, you could actually do it manually. So the first thing we want to look at when we're talking to our client is we like to do what's called a net worth statement. So you see that on the left side of your screen there. Or right, depending on how you look at it, anyway, on your left side of your screen, you'll see a net worth statement. That basically says assets and liabilities. In other words, in this case here, this individual has investments of $200,000, also has real estate. Home, $600,000, cottage, $400,000, cash in the bank of $82,500. So the total assets in this particular case is $1,282,500. Okay, so those are your assets. But of course, you also have liabilities. And the liability is the mortgage is $500,000. Debts that they may have, $330,000. So the total liabilities is $530,000. So the net worth of this individual is $752,500 in pre-tax dollars. In other words, if this individual cashed out, in other words, they're leaving the country, whatever it is, and so they're just simply selling everything, on a pre-tax basis, once they paid off everybody, basically they've got $752,500 sitting in their pocket. Okay, so this is really a good exercise that you should go over your clients with, because many of them don't know how to do it. And they think they know, but really it's not a bad thing for you to do, because it really sets the stage that you want to help your client to develop an investment portfolio and everything else. Okay, so let's assume now that you've got all that. So the first thing we want to do is just remember that when a person passes away, the very first thing we want to do when a person passes away, of course, is settle the estate. Okay. In other words, what is the amount that we need in order to settle the actual estate and everything? And so the example that I've got there in front of you is that he's got assets of $200,000, as I said. He has a home, a cottage, but of course he doesn't want to sell the home and doesn't want to sell the cottage. So you notice there that it's blank. In other words, no, when I die, I don't want you to use the home or the cottage to pay the bills around me. I want the home to remain in my family. I want the cottage to remain in my family. Okay, that's fine. But you can use the cash that's in the bank. In other words, when I die, I've got $282,500 of liquid cash that could be used to pay off my last expenses. Okay, so that's the asset side of the equation. Now, the next thing we have to look at is, okay, well, what are the final expenses? What are those expenses? When you pass away, what would you like? In other words, if you could write a big check today, Mr. Jones, and because you want to leave your family with no debt whatsoever, what would that be? Okay, so let's take a look at your final expenses. A funeral cost, $20,000, taxes of $160,000. Again, you don't want to sell the house, of course. You don't want to sell the cottage, but you do want to get rid of the mortgage, don't you? Yes, I do. Of course you do. $500,000. You want to get rid of your debts? Yes, I do. $30,000. In other words, you want to leave your family with no expenses. So your final expenses upon you dying is $710,000. You've only got $282,500 in assets that could be used to mitigate that final expense loss. So therefore, we need to insure you, Mr. Jones, for $427,500. In other words, to basically clear the estate, you need around $500,000. So this is a very much of a worthwhile exercise to go through with your client in terms of settling the estate. So that's step one, is what do we have to do to have enough money so that the estate is completely settled, so that your spouse, your children, all that don't have to worry about debt. Okay, yes, they have living expenses as we go forward. We'll discuss that in a moment, Mr. Jones. But at this point, if we insured you for $500,000, your estate will be well taken care of, your family will be well taken care of, and we can move forward. Now, let's take a look at your family. So, as I said, the cash need is $427,000. So now this is where it gets a little bit complicated, and I urge you to go through the life insurance module and of course the taxation module because it does a good job of trying to explain this. So I will do my best to cover this. Let's assume for a moment. So we've taken care of the estate. So we've got $427,500 of insurance. Let's say round it off to $500,000. Okay. So now if the husband dies, so the husband is dead. The spouse is still working, obviously, so the survivor's income is the spouse's income, which is $45,000. In other words, Mr. Jones, if you died, will your wife continue to work? Yes, she will. Well, what is her income? It's $45,000. Okay, great. And by the way, we also have net rental income of $8,400. Okay, so in other words, the continuing annual income, should the husband die, will be $53,400. However, the continuing expenses are $61,000. Remember, you would have gone down a list, okay? And again, on the actual form, which is beyond the scope of this, but the actual form is okay. How much for gas? How much for heat? Hydro? How much for food? How much for education? In other words, we total all of those expenses here, and we discover that your expenses are $61,000, but your continuing income is only $53,400. So therefore, you have a shortfall of $7,600. In other words, you're short $7,600 per year. So therefore, we need to capitalize that $7,600. In other words, you need to ensure that we have a fund that will generate $7,600 a year for you. So how we do that is we assume a certain interest rate. Now on the exam, they'll tell you what the interest rate is. So in this example, it's 6%. So you take your 6%, and you divide that into your $7,600, and you discover that it would be $126,667. In other words, the capitalized value of your total income need is total income need, which is $7,600, okay, divided by the interest rate, which in this case is 6%. And so therefore, it's $126,667. So, Mr. Jones, we need to insure you for $126,667 plus $427,500 for a grand total of $554,167. Okay, that is the amount of insurance should Mr. Jones die. What if it's Mrs. Jones that dies? So the wife dies. But Mr. Jones' income, survivor's income, is $100,000. The rental income is the same, $8,400. So we now, when Mrs. Jones dies, Mr. Jones still has $108,400 coming in every single year. The expenses, of course, will be the same, so that doesn't change. $61,000 still there. So now, in actual fact, we have excess. We have more money than we need. We've got $47,400 in excess money. So therefore, we do not have to capitalize it. The only time you have to capitalize is if there's a shortage. So when the husband dies, there was a shortage of $7,600. So we needed to capitalize that. So we divided by 6%. But when the wife dies, it's actually plus $47,400. So therefore, we don't have to capitalize it. So therefore, the only thing we have to insure the wife for is $427,500. You'll notice that the estate tax is the same regardless of whichever one dies. See, that doesn't change because let's face it, whichever one dies, we want the estate to be taken care of. So therefore, whether the wife dies first or the husband dies first, the estate debt is going to be the same anyway. So that's why you'll see that the $427,500 remains the same. So the only real value, variable rather, is who dies. Okay, so if the husband dies, we use his wife's income as continuing income. If the wife dies, we use the husband's income as continuing income, and we go ahead and we do what we need to do. Okay. Now, you'll see on the right side of your screen there the impact of taxation. You may get a question on the exam in terms of, well, yeah, that's great. You're getting 6% on your money, but that's before taxes. Well, what about if it's after tax? What if we have to do the calculation by after tax? Well, if you have to do it by after tax, then you can't use 6%. In other words, if you're in a 30% tax bracket, remember you only have 70% that you actually keep. So 70% times 6%, in actual fact, it's only 4.2%. So when you capitalize it, you have to use 4.2%, not 6%. Okay. If you're using the inflation factor, in other words, real interest rate, which is predominantly what it is, it's basically 6 minus 2. Okay, so 4%. I know it's 3.92, but you can round that off to 4%. Okay, and of course, if you use both the inflation as well as the taxation, then of course that reduces it down even further to 2.15. So on the exam, I don't think you're going to get a question on the simultaneous impact of taxation and inflation, but I have seen it in terms of the impact of inflation. Usually that's the one that you should be familiar with. So what they'll do is they'll give you what's called the nominal rate, which in this case is 6%, and then they'll ask you for the real interest rate. So real interest rate is nominal, which is 6%, minus, in this example, 2% is the inflation, so the real interest rate is 4%. So when you capitalize this, it will be, in fact, 4%. Okay. Once again, I know it gets confusing, but if you have any further question on this, just email me. I'll be glad to give you another example, because you will definitely get a question on the exam on this particular. This is fundamental core stuff that you need to know to figure out how much insurance your customer needs, your client needs. Okay. When we look at an insurance contract, there are a number of parties, obviously, to the insurance contract. And basically, the insurer is, of course, the insurance company in question. Okay, in other words, the manufacturer is the insurer. Okay, the insured is the owner of the contract, so the policy holder, basically. Now, the insured could also be the life insured. In other words, if it's the insured and the life insured are the same person, then is what they call personal insurance. So, for example, if I buy an insurance policy on myself, then I am both the insured policyholder, in other words, and the life insured. But if I buy a policy on you as my spouse or my partner or my key person, then I am the owner, I am the insured, and you are the life insured. So because the owner insured and the life insured are different, then it's called third-party insurance. Okay, so if it's the same person, it's personal. If it's a different person, it becomes third-party insurance. Okay, and then of course you have the beneficiary. Okay, the beneficiary is of course the person who receives the money. And we always advise you always to have a contingent beneficiary. In other words, a secondary beneficiary, because in the event that you pass away, and the beneficiary also passed away at the same time that you did. In other words, there is no beneficiary. So you and your spouse were both on a plane going across the Atlantic. The plane went down. You both passed away. There's $500,000. You named your spouse the beneficiary. The insurance company says, well, what happened to the beneficiary? The beneficiary's perished. Is there another beneficiary? No, there isn't. Then the money will be paid to the insured's estate. Not the beneficiary's estate, but the insured's estate. You want to try to avoid that. Remember, we said that the estate is taxable, creditor protected, creditor attacked, and all that sort of stuff there, okay? So we always recommend that to avoid the money going into the estate, that you have a contingent beneficiary, okay? On the other side, under the insured, basically, you should also have what's called a successor policyholder. In other words, if I own a policy on my spouse, so I'm the insured and my spouse is the life insured, and I die, there's no death benefit because the life insured is still alive. But who gets the policy? Unless I have a contingent policyholder, in other words, a successor policyholder, once again, my estate will own it. And that's not a good thing. So I should also, in a third-party policy, you should also have what's called a successor policyholder, which is at the left side of your screen. Okay. So in other words, whenever you have a third party, you should always have a successor, just to make sure that the monies do not go to the estate. Okay. Now let's look back to the beneficiary for a moment. In terms of beneficiary, as most of you are probably aware, there is what we call revocable and irrevocable beneficiary. Okay. A revocable beneficiary basically means that you, as the owner of the contract, can do whatever you want. So if you want to change the beneficiary, you do not have to notify the beneficiary, the revocable beneficiary. You just simply go ahead and do it, and that's all. You don't have to get permission from them. Okay? Basically you have all the control. If you want to borrow money, you want to collateralize the policy, you want to cancel the policy, you want to increase it, decrease it. In other words, whatever you want to do, because the beneficiary is revocable, a revocable beneficiary has no legal rights. Okay, all the rights lie with you as the owner of the contract, the insured. Okay. On the other hand, if you name somebody irrevocable beneficiary, then you have moved your rights over to that beneficiary. So now, in the event that you want to change beneficiaries, the irrevocable beneficiary must give you permission. Okay, and that could be very, very difficult. So you've got to be very careful before you name somebody irrevocable, because once you've named them irrevocable, then they become part of the contract. So if you want to change beneficiaries, you've got to get permission. If you want to cancel, you've got to get permission. You want to increase it, you want to decrease, you want to borrow money, whatever it is you want to do, you might say that you now jointly own the policy, and so therefore both of you will have to sign off. And that could be very, very tedious. Particularly in the event of a marital breakdown or something, it'd be very, very difficult to change beneficiaries for obvious reasons. So we caution you to be careful. So in common law Canada, it is automatically revocable unless you specify irrevocable. And in Quebec, of course, which is a civil law, it's automatically irrevocable unless you specify revocable. So therefore, be careful. So in the common law provinces, the 9 provinces, 3 territories, it's automatically revocable unless you specify otherwise. Okay. A contract can be obviously a legal person or a trust can own a policy. So a natural person obviously is you and I. Okay, so the life insured must be a natural person. However, the insured, the owner of the contract, could be a natural person, or it could be a legal person, such as a corporation. So, for example, your company buys insurance policy on you. So the legal person is your company. The corporation owns a policy on you. Okay, that's a legal person. Or, again, a trust. You may have a trust that you're leaving money to your child or whatever, and you don't want to leave the money directly to the child because they may not be able to manage it properly. So you leave the beneficiary, the trust. The trust buys a policy on your life, pays a premium, and is also the beneficiary, let's say. Okay? The trust, again, is a legal person. So when we're talking in terms of ownership, it could be a natural person, it could be a legal person, it could be a trust, anything along that line. When we talk about the life insured, then we obviously have to be only a natural person, because only natural people die, get disabled, get sick, all that kind of stuff there, okay? It can also, the beneficiary can be children. Okay, children can also be, but a cautionary note in that while we are saying the beneficiary can be a child, if that child is a minor, they cannot receive any monies. So if on the exam they ask you, can a child be a beneficiary? The answer, of course, is yes, they can be a beneficiary. But can they receive monies? No. Monies cannot be received. So in the event of that situation, the monies will be paid out to a guardian or a trustee or public trustee. And the money will be kept, managed, and everything until that child is age 18, at which time then the monies will be released. So monies cannot be released until that child is age 18. So basically we're saying is that not a good idea to name a child as a beneficiary. Either have a natural person or a legal person or a trust that will manage that money until the individual becomes age majority, and then of course the money can be released at that point. Okay. So as I've said, in death benefits, basically, insurance policies pay out death benefits, okay? The vast majority of insurance is sold in what we call level death benefit. In other words, you have $500,000, it's always $500,000, and all that sort of stuff there. However, there are a number of policies out there that will have what's called an increasing death benefit. So, in other words, it goes up according to the consumer price index, or 2%, 3%, In other words, for the individual that's concerned about inflation, then they may want an increase in death benefits. Remember, with universal life, we said that they could do that. Also, term insurance has an increasing term insurance, for example. So these are for people who are saying, yeah, I know the $500,000 sounds like a big number now, but 10 or 15 years from now, it won't be worth very much. How can I protect myself? So they're looking for an increasing death benefit. Okay? There's also a decreasing death benefit. This is primarily mortgage insurance. So this is the stuff basically that the bank sells to people that get their mortgage from a bank, for example, or a credit union or whatever, and it will decrease according to the mortgage, basically. It really is not that popular because it only really covers the balance of the mortgage, and it leaves no additional funds for the family or anything along that line. But nonetheless, it is there. Of these three, the cheapest will be the decreasing benefit, because remember that the insurance company's liability decreases as the years go on. So year by year, the amount of coverage actually decreases. So their exposure is decreasing. So therefore, they reflect that in giving you a lower premium. The increase in that benefit, of course, is the most expensive one. Because, of course, the liability increases as the years go on. So obviously they're going to ask you to pay additional amounts and everything else. Okay. So what we're saying basically is that this is what you've got essentially is three options: an increase in death benefit, level death benefit, which is the most common, and of course decreasing death benefit. Those are essentially the three different options that are available, whether it be term insurance, whole life, term insurance, or universal life, whatever. These are all things that are available to their clients. Okay, so let's take a look now at some of the features of the lives insured, you might say, and let's look at first of all the single life coverage, which is again, for the most part, the most of the insurance is sold is single life coverage. So you've got a male, age 45, face amount of $100,000. The premium is $45 a month, a year, whatever, doesn't matter. Female, age 40, $100,000, premium is $35 a month. That's pretty straightforward. Okay. However, two other ones that you should be aware besides single coverage: joint first to dies. This is generally used by younger people. So in other words, when a joint first to die, there's really only one death benefit. Okay, it's only one death benefit. So let's say you had a mortgage of $250,000, and the only concern you really had was, look, if either one of us dies, I want the mortgage paid off. Well, instead of buying two $250,000 policies, which can be rather expensive and you may not be able to afford it, you can buy one joint policy, joint first to die policy, for $250,000. The premiums will be considerably lower, and whichever one of you dies first, $250,000 gets paid out, mortgage is covered, and that's the end of that. So joint first to die, very, very popular with young people that have a common debt, dependency period with the kids, things of that nature, limited resources, need lots and lots of coverage, that kind of stuff there. Joint last to die, on the other hand, is generally speaking for older people. These are people that have estate issues. So on the exam, you will definitely get a question about estates. So whenever you're talking about estates, what they're referring to is joint last to die policies. In other words, how would you structure this? You would structure this joint last to die. I said to you that in a spousal rollover situation, the amount of debt, the amount of taxes is deferred until the spouse actually passes away. So, for example, I have $100,000 that I bought a cottage for. When I pass away, it's $250,000, but my wife is going to be the one that's going to inherit the property. So, therefore, the tax is deferred until she passes away. So, when she passed away, it's worth $500,000 now. So now what happens is the difference between the $100,000 and the $500,000, that will be the capital gain of $200,000, and $400,000 rather, and then of course $200,000 will be taxed, and the other $200,000 will be tax free. That $200,000 that will be taxed, taxes have to be paid on that. How do we cover that taxation? Well, what would happen is my wife and I, let's say, would insure ourselves for $100,000, let's say on a joint last to die. I die, nothing gets paid out. When she dies, $100,000 gets paid to our children, and that money then is used to pay the tax on the cottage, and that way the cottage remains in the family because the taxes are paid. So for estate purposes, is joint last to die is what on the exam what they're going to want you to know. And generally speaking, while any permanent insurance product will work, the most favored product for joint last to die is termed to 100, because the person who's looking at estate issues isn't really all that concerned about accumulating lots and lots of cash in their policies, tax exemption, all that wonderful stuff. They're really concerned only about making sure the estate has enough liquidity to pay the taxes so that the cottage and the house and all the other stuff there doesn't have to be sold. So if they ask you a question on the estate, how would you structure it? You would structure it with joint last to die, and the favorite product is termed to 100. Basically, is what we're referring to. Okay. So let's go back to term insurance for a moment. There is what's called non-renewable term insurance. That is, in other words, you buy a 20-year term policy that's fixed for 20 years. The end of 20 years is finished. You can't renew it. There's nothing left, and that's all there's to it. So that's what they refer to as basically non-renewable. It's for a fixed period of time, 20 years, 25 years, 30 years, and then at that point it dies. So if you die within that 30 years, fine. If you die after 30, the policy simply expires. That's the end of it. Renewable term, of course, basically means that at the anniversary, whether it be a 1-year renewable, 10-year renewable, whatever, it automatically just renews without any kind of medicals or anything along that line. Both renewable and non-renewables could have what's called a convertible option. Okay, pretty well every term policy out there has a convertibility option. So you can convert to permanent insurance. Can you make me the presenter? I'm sorry, I don't know really how to do that. My apologies. I just can't do that from my end. You're going to have to figure that out. So going back to here, the convertible term option basically says that you can convert the policy to permanent insurance within the conversion period without medical evidence. And that's the most important part. So that if you were, let's say, had a 30-year non-renewable term policy, and you were now, let's say, 25, and you had a terminal illness of some sort, or you're uninsurable, and that policy is going to expire in the next couple of years, whatever's going to expire, you may want to convert that policy to permanent insurance. But because you're uninsurable, nobody would insure you. But because you've got the convertible option, you don't have to worry about insurability. It would automatically, they will allow you to convert without medical evidence. All you have to do is pay the attained age premium. And so you don't have to worry about medical questions, being insurable, all that sort of stuff there. And of course, the vast majority of term insurance product today is renewable and convertible. Okay, so 10-year renewable and convertible, 15-year renewable and convertible, 5-year renewable, and so on and so forth. Okay, so that's the one that most of you will probably sell, is a renewable and convertible term insurance. But you should be aware that the other ones also exist. Okay, so let's move on here. So let's take a look at another type of renewable policy. Okay. For the most part, in renewable policies, the amount of insurance always remains the same. In other words, it is a level death benefit. Basically, it doesn't go up every year, that kind of stuff there. It is a level death benefit. And what happens now is you pay a premium. Let's say it was 10-year renewable. So at the end of 10 years, it goes up. Then another 10 years, it goes back up again, and so on. But you notice that the amount of coverage always remains the same, okay? So the maximum age and premiums are generally specified in the policy. So you have to look at the insurance company that you're dealing with to see what is the maximum issue age and what is that expiry date. Most term insurance policies will not go beyond age 80. In fact, the vast majority actually terminate age 75. But there is the odd company, because today people are living longer, that will go to actually age 80. Okay. Now, you can buy what they call a renewable term. In this case here, the renewable term is a 20-year renewable. So you can see there, 1 to 20, let's say the premiums were $100 per month. 21 to 40 went up to $220. 40 to 50 goes up to $800. In other words, it just simply goes up, all the times on the renewal dates. Okay. So and that is basically guaranteed all the way. No questions are asked. You don't have to give us any proof. It just automatically does so. What if you were really in good health and you are prepared to give us evidence of insurability? at those points, okay, at those renewal points. And by doing so, if you prove to us that you're really in good health, we may actually give you a lower premium. And that's what they call a re-entry term. So a re-entry term allows you to basically say, okay, on the renewal date, if I give you my medical history, basically, and I can prove to you that I'm in really good health, you can give me a better rate. So here's an example. So you start off year 1 to 20, $90 a month. 21 years, you end up going through a medical and everything else, and you're in good health. You pay $200. If you were in poor health, you pay $280. In other words, the poor health one is guaranteed. Okay, in other words, you're not going to pay more than that. So you will know that right at the beginning. So this is not a surprise. You're going to know that a worst case scenario, 20 years from now, you're going to pay $280 a month. However, it could get better. If you are prepared to give us the medical evidence and everything else, we could, in fact, give you a better rate. So we will assess that risk. So in our example, we assessed it, and we figured that $200 will do the job. But let's say you were in terrible health and basically uninsurable. You cannot pay more than $280. In other words, the $280 is the top line, but you could actually pay less. So there's two kinds of renewable terms. The ones that are fully guaranteed, no questions asked, automatically renews, and re-entry term where you do have that option. So once again, you have to look at the insurance company that you're dealing with to see which is a better route for your client. When we talk about whole life insurance, permanent insurance for that matter, okay, we have what's called non-forfeiture benefits. So these are benefits that basically allow you to have access of some kind to the cash value of your policy, okay? And that's why they call it non-forfeiture, because you're not forfeiting and you're going to get something out of that, okay? And so the first one, of course, is you simply cash the policy in. So let's say you've got $50,000 sitting in there, and you decide, I've decided I'm just going to cancel the policy. You'll get a check for $50,000. It'll get simple as that. So in other words, the CSV is the account value minus any kind of surrender charges. So you'll see that on Universal Life, for example, there's two tables. There's the account value, and then there's the surrender charge that's attached to that, and then you'll see the net, which will be the CSV, okay? So CSV is basically account value minus any kind of surrender charges. A cautionary note. So in this example, they're saying the face amount is $500,000 and the account value is $270,000. The ACP is $180,000. What we're saying is that if you decide to cash in the policy, you're going to get $270,000. That's fine. But remember that $500,000 is now gone. Okay, it's finished. There's no more coverage. You got your money, and that's the end of it. Okay. What if you still wanted to have the $500,000, but you didn't have any money to pay the premium? In other words, you had a bad year, or whatever the case would be. You could, in fact, borrow against the policy. In other words, automatic premium loan. Okay, is something else that you could have, an APL, okay, automatic premium loan, and they will just simply take out the money on an as-needed basis to essentially pay the premium for you. And of course, upon you passing away, whatever the loan balance is will be deducted from the $500,000. Okay. Later on, in your years, in your 70s or 80s, for example, you may not need $500,000, but you still need permanent insurance, but you don't need $500,000. You may only need, let's say, half it or whatever it is. You can buy what's called reduced paid-up insurance. Now, you will get a question on the exam on reduced paid-up insurance. Okay, usually we'll have one of these. So what happens here is that you're saying, and let's just use the example here. You can say, okay, I've got $270,000 sitting in there. I would like you, insurance company, to use the $270,000 as a single premium that will buy me a reduced amount of insurance that will cover me for the rest of my life without me ever to have to pay another dollar. In other words, use the cash that's in the policy as a single premium to basically buy me whole life insurance, buy me insurance that will cover me for the rest of my life. obviously, because you're no longer paying any premiums, the amount will be reduced. So it could be reduced, let's say, 400,000 or something, whatever. But then that 400,000 will be completely paid for the rest of your life. You never have to put another dollar into this here at all. So it is reduced, but it is paid up insurance. It will cover you for the rest of your life. So if an individual still needs permanent insurance, doesn't want to pay any more premiums, does have cash sitting in the policy, they can use the cash in the policy as a single premium to buy whole life insurance basically on a reduced basis that will cover them for the rest of their lives. Okay. The alternative to that, if the client says, no, I need $500,000, but I don't want to pay any more. I'm tired of paying all these premiums and everything else. This is something else we can do. Yes, you can use the cash that's in the policy right now to buy term insurance, what they call extended term insurance. Okay. And so therefore, it will still be the 500,000 will still be there. However, it will expire. Like all term insurance, it will expire. So the actuaries then will figure out and say, okay, Mr. Jones, based on the money you've got in the pot and everything else, you'll be insured for the next 15.7 years, let's say. Are you okay with that? Yes, I am. Sign right here. And so therefore now you have an insurance policy that is worth $500,000, but you're only going to be covered for 15.7 years. Okay, so on number 3 is you're covered for a reduced amount, but covered for the rest of your life. Number 4, you're covered for the same amount, but it will be for a limited period of time. So you've got to be careful of that. Usually the extended term insurance is useful for people much, much older or people that have been given bad news. In other words, are terminally ill, and they're saying, okay, well, there's no point in me continue on putting more money into this thing. I'll just use the money that's already sitting in there, and it'll use that to pay for the insurance, basically. So these are very, very useful tools to use with what they call non-forfeiture options. Okay. If you're buying a participating policy, remember that whole life comes in 2 forms, participating and non-participating. Today, of course, non-participating policies are very, very useful, okay, and very, very popular. So today, what can you do with the dividend option? Remember, the dividends are not, of course, not guaranteed, okay? But nonetheless, at the anniversary of your policy, if you have a participating policy, you're going to get a letter saying, here's the dividend. What do you want to do with it, okay, basically? So here are the 5 options, and you need to know all of them, basically, for exam purposes. So the first one, of course, is cash it in. In other words, send me a check every year for whatever it is, and that's the end of that, basically, okay? So number 2 is use the dividends to pay my premium. You could pay off the entire premium. It all depends on the size, obviously, of the premium and the size of the dividend. Okay, or you could use to pay partial amount of the premium. Whatever. In other words, instead of sending me a check, but I'm just going to spend it anyways. Why don't you just use it to reduce my cash outlay on my annual or monthly premium or whatever the case may be. Or you can let the money sit there. Okay, in other words, accumulated interest. In other words, you can invest it with the insurance company, and you can put money into interest accounts, securities funds. In other words, they have a number of options that you can pick and choose. Okay, so in other words, let the money sit and pay me some kind of an income, depending on the interest or the investment that I actually have and everything else. Okay. So those are what we call essentially your cash options. Then there are 2 insurance options. And the one that you predominantly, and we probably will get a question on the exam because it's extremely popular, is option number 4. Additional paid up insurance. In other words, use the dividend to buy me more insurance without medical evidence. That's the key. So basically what happens is the dividend is used as a single premium to buy a chunk of insurance without medical evidence. So if the client is saying, I would like to have a product that the insurance increases year by year, however, I don't have to put any more money in there, what would you recommend? Well, what you're recommending is a participating whole life insurance policy with option 4, paid up addition option for the dividends. So when the dividend is declared, automatically the insurance company say, okay, how old is the individual? What is the dividend? They do the calculation, say, okay, here's an extra 10,000, here's an extra 50,000, whatever the case may be. And so therefore it is fully paid for. So the insurance increases year by year. based on whatever that dividend happens to be and your age. And again, without medical evidence. So that is the most popular option. So likely is this one you're going to get on the exam. Okay. You can also use the option to buy 1 year term insurance. 1 year term insurance. So yearly renewable, basically, equal to the cash value that's in the policy. So if, for example, at the date of the anniversary, you have $50,000 of cash value sitting in that, and you chose option 5, what they'll do is they'll buy 1 year term equal to $50,000. So for the balance of that, for the remainder of that year, basically, for your $500,000 of coverage, for example, you now will have $550,000. So if you died anytime during that year, you get the $500,000 plus the $50,000. Okay, but remember that it's only is 1 year. So next year, if no dividend is declared, you're going back down to $500,000. Whereas with option 4, if no dividends are declared, remember it's already paid for. So whatever they gave you is still yours. You never lose that. Whereas with option 5, it is a yearly thing. So if next year they don't declare a dividend, or dividends very, very small, then the amount of coverage will of course be small as well, or non-existent. Whereas option 4, and that's why it's so popular, is that even if they never declare a dividend again, the amount they gave you is still fully paid for, and so therefore you never have to worry about ever losing that particular amount of coverage and everything else. Okay, so option 4 is usually the one that they'll have for exam purposes. So let's look at universal life. As I said, it is extremely popular. And as I said before, the client-based deposits, the money, there's no modal factor, so basically just divide by 12. There is the premium tax, of course, 2% or 4%, depending on where you are. The money goes into the investment account, GICs, daily interest, mutual funds. It is exempt. The side fund, of course, is non-exempt. And from there, we will deduct the mortality charge, administrative charges, and everything, okay? And the life insurance, of course, you can buy level cost of insurance, in other words, term 100, or yearly renewable term, okay? So your younger ages, YRT is usually the one that they choose because they're quite young, so therefore they can save a substantial amount of money by simply minimizing the cost of the insurance. Older people, they tend to use more level cost of insurance. Just be aware also that the YRT, because it increases every year, one of the problems with using YRT is that if the investment account doesn't increase equal to the YRT increase, then the client may be asked to put in more money. In other words, the premium is not guaranteed when we are using YRT, whereas the minimum premium when using level cost of insurance is fully guaranteed. The YRT premium, minimum YRT premium, is not guaranteed. So if the investment account is not keeping up with the cost of mortality, then the client may be asked to put in more money, and that could be a drawback. So you've got to be aware of that. In other words, what's the danger of using YRT? And the danger is that the cost of insurance could outstrip the investment account, in which case then the client will have to end up putting in more money, or the policy will end up lapsing and everything. So you've got to be very careful with that, okay? The beautiful thing about universal life, of course, is that it's very, very flexible. Okay. As I said, the flexibility, you can put in money, you can stop making payments, you can increase the amount, you can lower the amount. In other words, it really is a plan that is a managed product. So you when you're selling this to the consumer, it's not something that they buy and they never see you again. It really has to be managed. You have to manage the investments, you have to manage the premiums. So there is a certain amount of risk involved with universal life. Okay. But the flexibility is the thing that most people like. So when you're selling universal life, you got to make sure that the consumer is aware of market conditions, has the ability to pay more if they need to pay more, likes the flexibility. Like self-employed people, for example, 1 year they may have a lot of money, the following year they may not have much money at all, and therefore they may only be able to pay the minimum. So that flexibility, whereas with whole life, there's no flexibility. The premium is a premium is a premium. Term insurance, the same thing. Universal life, there's a lot of flexibility. And as I said to you before, with universal life, there's 4 different death benefit options: level plus account value, which is the most popular; index, level plus premiums. You can also add lives insured. In other words, on one policy, you can have your spouse, your children, all that, all under one. So it saves you a lot of administration charges and everything else. And you can also substitute a life insurance. So this is really more for corporate insurance, where if one of my key people has left and I own a policy on that person's life, I may want to keep that policy and then give that policy then to a new employee, basically. And so I'm basically substituting lives insured. Again, it's more complicated than that, but it's beyond the scope of this particular lesson. But you can see that the beauty of universal life is its enormous flexibility and everything, but it's not for everybody. And usually I caution that if you're going to sell this product, it really is more for the higher end of higher net worth client, not for the lower end. Lower end, better participating whole life is probably their best bet for that kind of situation. There are a number of riders that you can add to the Universal Life and to other plans for that matter, and almost every plan out there. You can buy what's called paid-up editions. If you remember, with participating whole life, we said that one of the options was that you can use your dividends to buy more insurance. Well, what if you buy Universal Life? And Universal Life is non-participating, but you like the idea of increasing the amount of coverage as the years go on. You could actually buy a rider. You could add that on as paid-up additions, and you can then use those paid-up additions to buy more insurance at your leisure. Basically, use it, as the way you want. I would put an asterisk next to that because usually there's an exam question on paid-up additions, so you should read that. And the book does a good job explaining how that works as well. Of course, you can add term insurance riders. Not everybody can afford $500,000 worth of universal life or a whole life or term to 100. But they like the idea of permanent insurance, but they need $500,000. So you can sell them, let's say, $100,000 of permanent insurance, and you can actually have, let's say, $400,000 worth of term insurance if you want. So they still have the full coverage, but they now have it permanent plus temporary insurance. You can have a family rider that insures the spouse plus the children. You can have a rider that insures only the children. So there's lots and lots of different kinds of things that you can add to these things to tailor the product to your client's specific needs and, of course, their budget. You can also buy what's called the GIB rider, Guaranteed Insurability Benefit. This will basically allow the client to buy more insurance in the future without medical evidence. That's the key, without medical evidence. And so therefore, if you're 30 years old, for example, you know that your needs are going to be increasing over the years. And, as long as you're healthy, every insurance company will be happy to insure you. But what if you're not healthy? Well, the GIB rider's for you then, because what it does is every 3 years or so, a letter's going to come to you from the insurance company and say, okay, you bought a $50,000 GIB rider. The options come up, sign this form right here, pay the attained age premium. So even if you're uninsurable, they're still going to have to give you that $50,000, you see. And so therefore, the GIB rider is very, very useful for people that are concerned about their future insurability. Also very useful for parents that buy insurance policies on their children and want to make sure that when their children become adults, they can actually buy more insurance, once again, without medical evidence. So the GIB rider is very good because it ensures your future insurability. The rider usually falls off around age 50 or 55, depending on the insurance company. But you do have a number of options before then. So depending on when you bought it, so for example, if you bought it at age 25, I think you have something like 7 different options before you hit 50 or 55 or something. So more or less every 3 years, You can also buy actual death and dismemberment rider. And this is a rider basically that says if you have an accident, it has to be an accident, and you died, it will pay. Basically, it has to be, however, an accident. Or if you're dismembered, we will pay. Now, remember that you have to die or dismember within 365 days of the incident happening. So if you die after 365, or you lose that arm or leg or whatever after 365 days, it will not pay. So it is crucially important that you do this right. In the first 365 days is this rider will kick in. And if you lose your life within the first 365, or you lose a part of your body, an arm, leg, foot, whatever, it will pay. But it has to be, the claim has to be put in within the 365 days in order for it to be paid out and everything else. And of course, you can buy a waiver premium rider. waiver premium rider is basically says that should you become disabled, unable to perform any duties whatsoever, after 3 months of permanent disability, we will waive all future premiums, as long as you're disabled, of course, and we'll also reimburse you the last 90 days that you shouldn't have paid. So if you're being paying $100 a month, let's say, and you become disabled and have no gainful occupation whatsoever now because of your disability, you continue to pay the $100 for 3 months. At the end of 3 months, the doctor says, nope, you're still not capable of going back to work. We will waive future premiums, and we will send you back your $300 that you shouldn't have paid in the first place. Okay, so it's a very useful rider to have for people that, particularly with term insurance, it's a good rider to have, because the other products, you may have some cash in this, you might be able to use some of that money, but with term insurance, it's just strictly death benefits, so it's a good idea to have waiver premium on term insurance. When it comes to underwriting, of course, there's a number of issues. The application, of course, is up to you. You as the field underwriter, as they call you, basically, fill out the application to the best of your abilities and everything else. You send that out to the underwriting company, so the insurance company, basically, and then, of course, they will assess your insurability. Okay, and it could be a situation where you have a policy is accepted standard. In other words, you're good. Here's policy. It could be accepted as a rated policy. In other words, you're not good, but you're still good enough that we can insure you, but we're going to have to charge you a bit more money. We can also issue a policy with exclusions. In other words, we're not going to cover you while you're scuba diving, or we're not going to cover you while you're hang gliding or skydiving. In other words, what we call a hazardous sports or occupation, or in other words, we could still insure you, but as long as you are doing that, whatever the exclusion is, we will not cover you. So, for example, as it says there, for travel or hazardous applications, whatever. So, if you're traveling in a war zone, for example, if you decide to take your holiday in Afghanistan or something, Syria or whatever it is, you're not covered. It's as simple as that. Okay, you're not going to be covered for that. But we still will insure you, but we're not covering you during that period of time. If you were on the plane and the plane went down, of course you would be covered, that kind of stuff. So there could be a policy that's going to be done with an exclusion. And of course, in the end, the worst case scenario is that it will be declined. And usually if we decline it, we are going to give you a reason for it. In other words, we will let your doctor know that, and then you can visit your doctor basically. Here's the reason why you couldn't, they could not insure you, whatever it is. On the left side of your screen, you'll see preferred. And we talked about that a little bit before. If you're prepared to give us additional medical information, and we discover that you really are very, very, you take good care of yourself, your height and weight is the right, you don't smoke, you don't drink, all that sort of stuff there, we could in fact give you a better rate than a standard policy. See, everybody's standard, you might say, but if you're really, really taking very, very good care of yourself, the insurance companies are quite prepared to even lower the premium further, so what they call preferred rates. Once again, you have to look at the insurance company you're doing your business with to see whether they have that provision, okay? Underwriting persons who are not Canadians is something, of course, that you're going to come across. Many of you are probably new immigrants into Canada, and you're going to come across this kind of situation. So underwriting a permanent resident, not a problem. Okay, if they have a permanent resident card, I believe they have a 9 number. That's not an issue. That's just a stepping stone to getting final approval anyways. So the insurance company will be happy to insure that individual, okay? Well, also, insure the people that are awaiting permanent residency status. In other words, if you do have that number, that 9 number, or you've got something that says, yes, you're well on your way, then of course they'll cover you for that as well. And of course, international students, they come in on what they call a student visa. And of course they can also be covered as well. But once again, I urge you to take a look at the insurance company's underwriting rules. These are not hard and fast rules. Some companies may have slightly different variations of these things. So you really should check with your respective company to see whether they will cover that individual before you go through all the trouble of explaining everything to your client and everything. So Some of the tools that insurance companies use in order to underwrite a case is, of course, MIB. That probably is the question you're going to get on the exam is what is the very first thing that an insurance company does when they receive an application? And that is an MIB, a Medical Information Bureau. Usually what happens is the idea of the MIB is to make sure that you're not being overinsured. The idea, of course, is that nobody should be worth more dead than alive. So if you are already well insured with another insurance company and now you want additional coverage and everything else, but your earnings do not really reflect the fact that you need that extra insurance, they may simply say, look, you're overinsured already or you're adequately insured. We can't cover you any further. The other thing that does, of course, is that if you've ever had a claim, disability claim or whatever, that's also registered under the MIB. So if you get a question on the exam, is what's the first thing the insurance company does when they get an application is they do an MIB. Okay, and that's where they get that additional information, you might say. Where does that additional information come from? It comes from an MIB. Okay. The APS, of course, attending physician statement, that comes right from your doctor. So the insurance company will order an APS from your doctor. They can order a medical checkup, and that could be a full medical, it could be a paramedical, whatever. They will order an inspection report. The basic could be verified that what you said on the application is in fact true. They could order an MVR, motor vehicle report. So if you've had 6 speeding tickets in 6 months, well, that's going to be a problem. Okay, so we've got to be careful of those kind of things. They could also check police record checks. If you had an accident, for example, they may check that and say, well, how many other accidents have you had? Whatever. Okay. They could also do a credit check. We know that people that are in debt tend to be bad risks. Okay, big debt. I'm talking about that. They pay. They're not keeping up with the monthly payments and everything else. They could be a bad risk, and so therefore they may check those kind of things as well. Remember, these are all tools. So what you have to look at is, depending on the company you're doing your business with, you have to check what their underwriting guidelines are. Every company has got their own underwriting guidelines, so you should be able to get that information readily without any real difficulty. And certainly before you talk to your client, you better know what these things are. Okay. Group insurance, by its nature, of course, is a third-party contract. And there's the insurer, so once again, it's the insurance company. The plan sponsor, that's the employer. Okay, that's not you. So therefore, they are the insured, the group insured. They will get issued a master contract. You are the group life insurance. In other words, you are the member, basically, okay? You're going to get a benefits booklet and certificate and all that, and of course you can name the beneficiary for your death benefit and everything, okay? Generally speaking, the insurance portion, the life insurance portion is term insurance, okay? So it's very, very basic coverage. You could buy extra coverage if you want to pay the extra premiums and everything else. You can also buy dependent coverage. There's also a conversion option. If you lose your job or you quit or the company closes down or you get fired or whatever it is, there's also a conversion option. All group insurance plans have a conversion option, but you must convert to a private plan within 30 or 31 days of leaving your employment. If you go beyond that 31 days, it's over, okay? So without medical evidence. In other words, if you want it without medical evidence, you have to do it within that 30 or 31 days. Otherwise, as they say, the party is over, basically, okay? Key person insurance, that is, of course, company owned. Company owns a policy on the life of a key individual. That key individual could be the most important person in the company besides the owner. It could be the best widget maker. It could be, whatever, okay? The premiums are not tax deductible. However, the benefit is tax-free to the corporation. In other words, if you were working for me, I end up buying a policy on your life, let's say for $500,000. I pay the premium. I don't deduct the premium because otherwise it'd be taxable. And when you die, I get the $500,000 totally tax-free. Okay, so key person insurance, very, very popular when you're talking about corporate insurance. Besides the owner, who's the most important person, obviously, and that's the one we want to insure. Okay. And the last thing we talk about is, of course, buyout insurance. Okay, if you're dealing in the corporate market, you're going to run into a situation where you've got partners. Okay, and the partners, what they want obviously is, in the event that either one of them should pass away, money should be available to actually buy each other out. So here's two situations that I want to explain. First one is what we call a crisscross arrangement. So we've got Jackal Inc. and we've got Jack and Alfred. They both own 50% each of of Jackal Inc. Okay, and they both pay a premium to the insurance company. Okay, so they in fact pay the premium on each other's policy basically. And so what happens is the premiums are paid to the insurance company, and let's say that Jack dies. Okay, so therefore we're dealing with Jack's estate. The insurance company will pay, and let's say it was $500,000 just for easy math, okay? The insurance company will pay Alfred, who's a living partner, of course, the $500,000, so it will be paid to Alfred, who owns now, and Alfred then will take that cash payment that they received from the insurance company, go over to Jack's, whoever's representing Jack's estate here, and basically give the $500,000 to whoever is representing Jack's estate, and then the shares are handed back to Alfred, and now Alfred owns the company. So that's why they call it crisscross. I insure you, you insure me. I die, you get a check. You bring that check over to whoever's managing my estate. My estate gives you the shares. You give me the check, and now you own the company. And that's what they call crisscross insurance. Very, very simple way of doing things. In some cases, however, people don't want crisscross. They want the company to own the policy. In other words, rather than Jack and Alfred owning a policy on each other's life, they want the company to actually own the policy on Alfred and Jack. So in this second example is what they call share redemption. So Jackal owns a policy, let's say $500,000 on Jack, $500,000 on Alfred. Jackal pays the insurance premium. Okay, so once again, Jack dies. Basically, the insurance company pays some money to Jackal. Okay, Jackal now goes to Jack's estate, and basically, here's the check for $500,000. Give us the shares. The shares are given to Jackal. Notice that the shares are given to Jackal, whereas in the other example, the shares were given to Alfred. So in other words, who's buying who? In the crisscross, Alfred's buying Jack. In share redemption, it's Jackal who's buying Jack's shares, not Alfred. You see, so that's why the difference. And so in a corporate redemption, what happens is the corporation is actually buying the shares of the deceased. And so therefore the corporation gets the check from the insurance company, uses that money, remember that capital dividend account that we talked about before, uses the capital dividend money basically to buy the shares from Jack's estate. Jack then hands over the shares to Jackal Inc. And now, in this case here, Alfred now owns owns everything essentially. So you need to know both of these. These are one or both will be on the exam for sure, because this is fairly fundamental to what we do when we're dealing with when we do a corporate insurance. Okay. Okay, so that is the end of today's session. Okay, so as it says there, if you have any questions resulting from this boot camp, please check the email address on the contact page of your website.